Welcome to Real Estate Live, where your questions get answered. We get to the point with the hot topics everyone is talking about twice a week. We go live on YouTube and Facebook at 9 a.m. Pacific time on Monday and Friday. Today's hot topic is all about buying down your rate. What does that mean exactly? And when you hear a loan officer say point, what is a point and how much does it cost? To tell us more about this is Celeste Harvey with Fairway Mortgage. We're going to have a robust conversation. Looking forward to a lot of engagement with you. Please use the chat box to drop us a question or simply drop your line in the comments below. We're happy to get back with you and make sure your questions get answered. I'm your host, Andrew Finney with King Realty Group in beautiful Las Vegas, Nevada. Let's go ahead and bring Celeste up and let's go ahead and get after it. Good morning, Celeste.
Good morning, Andrew, and hello, all of my YouTube friends. Hope you guys are doing well today and you're staying healthy.
Absolutely. And we got that new order by Governor Sisolak yesterday, too, to make sure that everybody's wearing their mask. So no matter any kind of political affiliation, I do believe it's best that we just all remember it's not about each of us individually. It's about us together. And remembering that we're always stronger and better together than we are not. And to wear your mask, please, when you're out in public, so we can keep our country safe, keep each other safe, and make sure that we're all healthy and COVID-free. So I know that we have a lot of nice things to talk about today, leading in with our mortgage rates. Why don't you go ahead and let us know what's going on, and I'll put up your MBS highway.
Perfect. Thanks, Andrew. Okay, guys. So, the last few weeks we've been showing you guys what's going on in the bond market. So we're going to get a little bit more of that today. Here you can see, we've kind of been tracking, bond pricing, and we've been, kind of looking at this 25-day moving average and then the 50-day moving average here. And you can see that we've kind of broken above both. So we broke above that support and bond pricing has gotten better, which typically is good for interest rates, mortgage interest rates. Here you can see the S&P 500. It's down a little bit today. And I really think that's because of the increase in COVID-19 cases. So that's causing a little havoc there. So it's something to follow and just see if we get any pullback here, because that could be positive for bond pricing. But overall, as far as mortgage interest rates go, we are still seeing historically low interest rates. You can see that bonds have been trading sideways for a long time. And, the bond market has been pretty stable all the way from April to May. And now as we're ending June and heading into July, we can really expect about the same amount of movement in the bond market because the Fed is still purchasing mortgage-backed securities. And, I've been talking a lot about this. The Fed, pledged that they're going to continue to purchase mortgage-backed securities and keep the mortgage market stable. So you guys will have a while to get in and refinance your home loan or purchase a home with a historically low interest rate.
That is very good information. So I know that you mentioned that you wanted to give some mortgage market updates as well. Specifically, you mentioned there was some activity on the forbearance process. Would you please go ahead and let us know what you're finding?
Yeah, so this week we got some news about mortgages in forbearance. We actually saw that mortgage loans in forbearance increased just a tad from 8.7% to 8.8%. So it's something that we should continue to monitor, because, when mortgage loans go into forbearance and, at the end of the forbearance period, we will see most of these mortgages, either, they have a lot of options as far as what they're going to do when they come out of forbearance. So we shouldn't see a ton of foreclosures, but it's something we do want to monitor along with the unemployment rate, which next week we're going to get all of the jobs report. We're going to get the ADP report and the BLS report. So we can kind of monitor mortgage forbearance as well as jobs and what's going on with that.
Good stuff. Thank you for that, Celeste. So, let's go ahead and dive right into the hot topic. But before we do, I saw a comment come in for Chad whenever we were getting ready to come live. So I wanted to go ahead and address this while we're talking about rates. So Chad asks, Andrew, what are the differences of rates? And remember, everybody, stay home, right? So Celeste, could you say what kind of rates there are? Because I do see that he was asking specifically what kind of rates.
Yeah. So, hey, Chad. Yeah, stay home. Hope you're doing well. Differences in mortgage rates. So mortgage rates, are going to be different depending on your credit score, depending on your loan to value, or how much money you're putting down on your home, or how much equity you have in your home. The loan program, is it VA, FHA, conventional, jumbo loans? Are you doing a 15-year loan that's fixed, or a 30-year loan? But what I can say is something that I've seen recently is that, we're seeing these low interest rates for a lot of people, and a lot of people are taking advantage of those. But I'm also seeing a group of people who are having a harder time of taking advantage of the historically low interest rates, and that's because their credit scores are low. So, for example, maybe there's a client who has a credit score between 580 and 620, they might have a higher interest rate, and they might even have to pay points for a higher interest rate just for us to originate the mortgage loan. So if you are looking to purchase or refinance in the near future, you definitely want to get with a mortgage lender, have that loan officer do an application for you, run your credit. If your credit score kind of falls in that range of 580 to 693, it might be a good idea to get with your mortgage loan officer to see what you can do to boost that score to 640 or higher, because once you're at 640 or higher, you're most likely going to tap into better interest rate pricing.
Cool. So thank you for that. So that you can see how fast I could go down a rabbit hole, but let's go ahead and get back to today's hot topic, which is, what is a rate buy down? And I think the best thing that we need to explain is, because you loan officers have your own vernacular. You guys like to say, oh, this is a point. This is a point. And a point to a real estate agent, a point to maybe, well, heck, all of us out there in the world means 1%, right? But when it comes to a loan officer, and Bill Barron actually laughed at me because I asked him this seriously, and he couldn't believe I was asking him seriously. I said, dude, I'm not a loan officer. But I said, hey, so whenever I bought my house that I have now in 2016, and he was doing my loan, I said, so if I buy a point, does that lower my interest rate from what you told me that I'm probably going to get? Would it lower it down to a whole new level? And he started laughing. He's like, no, that's not quite how that works. And then he started explaining it to me. So that's why I think we really have to begin with the beginning here and simply defining what is a point. And then we can better explain whether it's worth it or not to buy your rate down or not. So would you go ahead and just give us a simplistic definition of what a point is when lenders say that?
So a point is 1% of the loan amount. So a point for someone with a $300,000 loan amount versus a $400,000 loan amount is going to have a different cost for that interest rate. So a lot of people get confused because they think like, oh, I'm buying my interest rate down by a point. So maybe they're thinking, okay, the interest rate is 4%. So if I buy a point, it'll be 3%.
Correct.
That's false. It doesn't work that way.
So how does it work? I wish it did too. So how does that work exactly? What does 1 point equal?
So 1 point equals 1% of the loan amount. And that pricing, it's going to be different every single day because the pricing changes every single day. It's going to be different between mortgage lenders. So it's something that your loan officer has to price out for you. It's not something that you can just calculate or determine on your own. So that's why it's important to work with a loan officer that you trust and that can explain this really well.
So, yeah, exactly. So speaking of explaining it very well, perhaps I need to rephrase the question. When we're saying what does a point equal, we understand the cost of the point initially is going to be 1% of the sales price. And you made the example of $300,000, which means that first point would cost $3,000. My question to you, Celeste, is what is a point? Is it a quarter of a point? Is it 1/4%? Is it an eighth of a point? how many points does it actually go down? What is the percentage basis that a mortgage interest rate will go down if somebody chooses to purchase a point?
It depends on the pricing for the day. So maybe we're going from a 3.5% interest rate to a 3% interest rate. And it doesn't always equal an even point. It really depends on how that mortgage lender does their pricing. So it could equal, a random number like 1.05%. So 1.05 points. So it doesn't have to be an equal number, and it's not always the same. And it really depends on the pricing. And that's why when we're locking in interest rates and your loan officer is calling you saying, hey, it's really important we lock this in, because as we know, pricing can change multiple times a day. It can change from day to day, week to week. So that's why when you're locking in an interest rate, it is a time sensitive thing. When your loan officer is calling you saying, hey, I think we should lock in right now. We should do it within the next hour or two. You probably want to listen to your loan officer and get that locked in.
And that would go back because you guys have the access to the MBS highway that we always use for the mortgage rates to show exactly the facts that go into the rates and how that's calculated. So that makes a lot of sense. Thank you. So it sounds like to me that if somebody wants to try to get a better interest rate and they're thinking about, hey, should I be buying down a point? It sounds like from what you're sharing with me, and please correct me if I'm mistaken, it sounds like they really would be wise just to have a straight up conversation, perhaps meet with the loan officer in the office so you can show them the screen, because you're telling me this thing fluctuates all the time. And maybe you could actually show them how on your MBS highway or whatever portal you use to show what the cost of the point is going to be and what that point actually entails. So if somebody is at a 4% rate, like you mentioned a moment ago, will it go down to a 3? Will it go down to a 3.75? So if that is always fluctuating is the basis of the point, and it's not known to be maybe an eighth of 1% or a quarter of 1% for the first point, right? Then I think it's very important that people be able to have that conversation with you, if you're their loan officer or any other loan officer across the United States, to know where that money is going and how will it impact them. Because when we start thinking through when does buying down a rate make sense, well, it would really always come to the first question that I like to ask as a trust real estate advisor: how long are you going to live in the house? Because if you're going to live in the house longer and longer, like 10, 15, 20, 30 years potentially, right? Or if it's your forever home, okay, then it might make sense, because on the amortization schedule, which is that schedule of the term of the loan, that'll start lowering the total amount that you are paying in terms of interest, correct?
Correct. Yeah. So Andrew, buying down an interest rate is a long-term savings plan. So you're looking at buying down an interest rate, but you're only going to stay in your home for 5 years. It probably doesn't make sense. And I actually have an example that I think will really, really help people understand, what we're looking at here. Can you guys see that? Okay. Oops. There we go. That looks a little bit better. Okay. So this is an educational example. For compliance reasons, I do have to go through this. The illustration is based on a conventional fixed rate loan amount of $300,000, a credit score of 740. Estimated payments include principal and interest only and do not include any taxes, insurance, or HOA fees. APR is defined as an annual percentage rate. Illustration is intended for informational and educational purposes only and should not be relied upon by you. Actual payments may vary based on individual client circumstances and market conditions. We are equal housing lender. There's my NMLS number. So let's get into the fun stuff.
Now that you got the legal compliance out, yeah.
Yes. So remember when I said when we're looking at mortgage points, or sometimes also commonly called discount points, these are fees that are directly paid to the lender in exchange for a reduced interest rate. So you're literally buying down the interest rate. And why someone wants to do this is because they want to save money on their monthly principal and interest. And that's why I've included the principal and interest in this scenario. And then really you're paying less interest over the life of your loan. So if your loan is a 30-year fixed loan, then you're paying less interest over 30 years. So I have 3 scenarios here, all based on the same loan amount, same credit score, 10% down, 30-year fixed conventional loan. Mortgage points here, see, you're paying 0 points. It doesn't cost you anything to lock in at a 3.25% interest rate. Here you can see you have your monthly principal and interest at $1,306. Now, maybe your loan officer calls you up and says, hey, Andrew, you have some options here. I think we better take a look at this. You can buy down your interest rate by 1 point, and then your interest rate will be 2.99%, or you can buy it down by 2 points and it'll be 2.75%. And then Andrew, of course, is going to say, well, what is the cost and what will my monthly principal and interest be? How much am I going to save? So you'll see 1 point costs $3,000. 2 points cost $6,000. 2 points is 2% of $300,000 loan amount. 1 point is 1% of a $300,000 loan amount. So as you can see, it is costly to buy down an interest rate. But we want to look at our savings over time. So you can see here, if you buy it down 1 point, you're saving $43 a month. But if you buy it down 2 points, you're saving $81 a month. And then you might say, well, hey, Celeste, how do I know this makes sense for me? How do I know, I'm going to benefit from this? Well, I'm going to ask you, hey, Andrew, how long are you planning to live in the home? Is this, your first home that you're only planning to live in for 3 to 5 years? Or is this your forever home that you're planning on living in for 15 to 30 years or even longer than that? And maybe you tell me, Celeste, I plan on living in this home for 15 years. So I'm going to do something what's called a break-even analysis, and we're going to figure out at what point do you break even. So here we can see we break even after 5.81 years. So almost 6 years it's going to take us to break even. So if you stay in the home for 15 years, you'll save $4,740. If you stay in the home for 30 years, you'll save $12,480. Mm-hmm. Then you might decide, well, hey, I'm going to stay in the home for 30 years. So maybe I'll get more bang for my buck if I buy it down 2 points and I have a 2.75% interest rate. It'll take me a little over 6 years to break even, but over 30 years, I'm going to save $23,000, over the life of my loan. That's a lot of money.
Yeah, it is.
So in this case, it does make sense if you plan on staying in the home for, 30 years or 15 years. But if you're only planning on staying in the home for 5 years, you're not even going to reach your break-even point. It makes 0 sense to buy down the interest rate. In that case, you would just lock in at a 3.25% interest rate.
That makes a lot of sense. And I think that graph that you popped up is extremely helpful. So I do want to say thank you for that, Celeste. I think that really at the end of the day, what it comes down to is always beginning with the end in mind. If you always ask yourself as a home buyer, or if you're deciding whether you want to refinance your mortgage or not, begin with the end in mind, which simply means how long are you going to live there? And by using that break-even analysis and understanding the math, by having that conversation with the loan officer, you'll know whether it's going to make sense. Because like you said, if somebody was going to stay in the house for only 5 years, right, then you know that it took 5.81 years to even break even if they spent the $3,000 up front for that mortgage. So it wouldn't make sense if you had a 5-year horizon to buy down a point, as opposed to say, hey, I'm going to stay in the house 10, 15, 20, 30 years. Okay, now it makes sense. But it all comes down to that break-even point. And it all goes back to the question of how long you're going to live in the house. And it's one of my favorite questions to ask every single family that I have the opportunity and blessing to represent here locally to purchase their home. How long are you going to live there? Because ultimately it dictates, your negotiation strategy. It dictates what you do with your mortgage options. It dictates a lot of different things if you truly see yourself living in that property for an extended amount of time. So I wanted to say thank you for taking the time to put that educational chart together. And I do believe that will be very, very helpful to a lot of people. And in fact, if you're watching us during the live or after the live, drop us a line in the comments. Let us know what you thought of the educational chart that Celeste used and if that was helpful to you, so that it can better prepare you for asking the questions of the loan officer, whether you're choosing to refinance or purchase your first home, second home, what have you. So thank you, Celeste. I know you like trios of words. So we go, thank you, right? Yes, you do.
Yep.
Yep. So thank you.
Yeah.
Okay, so let's get into
else. Yeah. I didn't mention was that it does depend on your loan program. Like, if you're buying down the interest rate on an FHA loan, but in a few years, you're going to refinance to get rid of your mortgage insurance to switch to a conventional loan, then, it probably doesn't make sense to buy down the interest rate. So also think about in the future, if you plan on refinancing and then, the cost of the interest rate too, so that is a cost that if you're purchasing a home, it's rolled into your closing costs. So it's going to increase your cash to close. So if you have the money and you're comfortable, spending the extra cash, go ahead and do it. But if you're strapped for cash and that money is better served just staying in your bank account, then that could be a factor too.
Good stuff. Thank you for that, Celeste. So let's go ahead and get into some viewer Q&A. And thank you for everybody with your patience and getting into the viewer Q&A portion. It is mine and Celeste's favorite part is engaging with you and answering your questions. So we addressed Mr. Chad earlier today. Then we have Jay-Z coming in over here. Jay-Z says, good morning. Good morning, Jay-Z. Jairo Enrique Loco Quevedo. Now, Jairo, Celeste, is actually one of my past clients. And most recently, in fact, just this week, we had the great pleasure of helping his daughter buy her first home together. So it was a lot of fun, too. So they're wonderful, wonderful people. He was asking about what is points as we were getting ready to go into the hot topic. Jairo, if you have any additional questions, my friend, please let us know. And please let us know what you thought of Celeste's presentation with the educational information she provided today about buying points. Jay-Z says, is it better to do a conventional or FHA if you have your 20% down payment? Now, I have a thought that's really brief, but Celeste, you're the loan officer here. What is your thought in its most simplistic form?
The easiest answer to your question, Jay-Z, is if you have 20% down, it's better to do a conventional loan because you get rid of the mortgage insurance. You'll have no mortgage insurance. You put 20% down on an FHA loan, you're still going to have mortgage insurance for at least 11 years. And then after the 11th year, it will fall off. So that's one thing people don't know about FHA loans is if you put 10% down or more, the mortgage insurance will fall off after 11 years. But you got 20%, go conventional all the way. If your credit, isn't high enough, see what you can do to boost it real quick. To get qualified for that conventional loan.
Absolutely. Thank you. And that was the same thought that I had was echoing the conventional loan. If you have 20% down every day of the week, jump on the conventional because you're going to get the sweetest of the terms, especially not having private mortgage insurance attached to it. And that's a cost savings of hundreds of dollars, especially given whatever the price point is you may be looking at. So it's smart move. Mangle Singh says, hello, sir. I am from India. I want to start my real estate business. Sir, how I contact you if I want to ask you something if I am confused. Mango, my contact information is in the show more description. Please feel free to email me and I'll see whatever we can do to try to help you out. So great. And thank you for joining us from India, by the way, my friend. Jay-Z says, is it better to do a conventional loan or FHA when you have 20% down? And would it be worth it to buy points on a $200,000 house at a 3.35%? So Jay-Z, we just hit the nail on the head for the conventional or FHA. on having 20% down. Now, if you're asking about would it be worth it to buy points on a $200,000 home at a 3.35% rate, I believe that Celeste would probably echo the sentiment, and please correct me if I'm mistaken, Celeste. Begin with the end in mind. How long are you going to live there? And make sure that you have the conversation with your loan officer, or reach out to Celeste if you would like to learn more about your break-even analysis and go from there. Because it really depends on how long you're going to live there. Wouldn't you agree, Celeste?
Yeah, it depends on how long you're going to live there. It depends on what the cost is to buy the interest rate down. We do the break-even analysis. We make sure you have enough savings to benefit you. If there's not enough savings to benefit you, then it doesn't make sense to buy down the interest rate. And if you have questions, there's my contact info.
There you go.
You got my cell phone number there, and then my email. So feel free to reach out.
And it's also in the comments in the description below, Jay-Z. Thank you so much for the great question. And thank you, Celeste. So then we move on to, let me see where I was here. Here we go. Mangal Singh says, sir, your video is very motivating to me. Thank you so much, sir. Sir, thank you from India again for joining us and for your kind words. Really appreciate your positive mojo and your support. It really means a lot. Chelsea Zupin says, I followed up with my loan officer. It turns out we had seller concessions left over after paying our buyer closing costs. This is what our loan officer used to buy down the rate. So, Chelsea, good job. Your agent and everybody involved did such a sweet job negotiating on your behalf that you actually had credits left over. And it doesn't happen very often, but when it does, and the seller not only paid your closing costs, but you had extra to buy down your rate, that's an awesome sweetheart of a deal. So I'm super glad to hear, my friend, that worked out for you that way. Bernard Mag says, hello, Andrew. On my loan estimate and closing cost details, there is a charge for $6,000 for originator compensation fees. Is that too much on a $340,000 loan? Thanks, Celeste.
Okay. Hey, Bernard. So it sounds like maybe they're charging origination points, which is different than mortgage points. So, for example, here at Fairway Independent Mortgage Corporation, we don't charge origination points. We have a fixed loan fee of $14.60 that we charge on every single loan, no matter what. So I would get with your loan officer and pop open that loan estimate and ask them, what is this origination charge that you're seeing? Ask them, are they charging origination points, or is this points to buy down the interest rate? You want to get clarification on what that fee is and what it's covering. So definitely reach out to your loan officer to get clarification on that.
Most definitely, because if it was a compensation fee, like you were talking about, an origination fee at Fairway Mortgage is about $14.60 for every loan, right?
So we don't have it's a fixed loan fee. We don't charge origination fees or anything like that. Yeah.
Where I'm going with this, Celeste, and where I'm going with this for Bernard is that $6,000 is a huge chunk of money. So you really, like Celeste said, need to gain clarity. So if I were you, Bernard, and you're in the process right now and you just received your closing cost details on your loan estimate, you should probably, my friend, come back to the stream later on, or maybe hang out for a few more minutes. But the first course of action I would suggest to you is drop the stream, give your loan officer a call so that you can have that conversation with them, just so you have peace of mind. Today is Friday. Don't go into the weekend with that question eating in your mind and in your stomach. Let's make sure that you get peace of mind and clarity before you go into it.
Yeah.
Now, asking the question
high. Probably,
it is.
It's probably points. Maybe you are buying down the interest rate, but yeah, you want to get clarity on that for sure.
Either way, get the peace of mind and the clarity so that you can make sure that you know what you're doing and what you're agreeing to moving forward. So Bernard, thank you for bringing that up. And I definitely hope that helps somebody else. I hope that helps you first and foremost, my friend, but I also hope that it helps anybody else that watches after the live stream. And speaking of that, if you're just joining us after the live stream, thank you again for joining in. Celeste and I love chatting with you and helping answer your questions. So let's move on. Jay-Z says, love the graph. I think I got it. See, Celeste, great job with that graph. It was very simple and easy to understand. Yulia says, very helpful info. Thank you both. And thank you, Yulia, for joining us. Claudia, thank you, my friend, for joining us. Claudia says, I have an FHA loan, and my mortgage company said the only way that I can get out of mortgage insurance is refinancing, even with more than 20% equity on my home. Celeste?
Yeah, so it all depends on with FHA loans is what year you purchased your home. For example, my mom purchased her home in 2012. So loans that were originated, I believe, before 2013 that were FHA loans don't have the same rule as loans that were originated after 2013. So FHA loans that were originated after or like during 2013, if you put less than 10% down, then the mortgage insurance will stay on for the life of the loan. And the only way to get out of it is to refinance into a conventional loan. But if you purchased your home before 2013 and you have an FHA loan, I would reach out to your mortgage servicer and find out when you can get that mortgage insurance off.
Okay, great. So you did say something today that, frankly, in 175 and counting rodeos that I've gone through from all the different loan types, except for USDA. USDA has not been applicable just yet here in the Vegas area because we're not all that rural. But that said, I never heard that after 2013 that an FHA home loan with a 10% down payment or greater can drop the MIP, mortgage insurance premium, after 11 years. So I do think that is very, very important to ask and very important to know if that is somebody's situation, because obviously the qualification standards between a conventional loan and an FHA loan, it's easier to get qualified for the FHA in terms of credit score requirements and stuff compared to that, and your debt to income ratio for that matter. You can be a little bit higher in your debt to income ratio than that of a conventional. So I think that that's worth mentioning. And I really do appreciate you bringing that little nugget of insight and wisdom, because I never, as many times as I go through this, Celeste, I never knew that. So thank you for enlightening us. And that's why we do this. I mean, we're all stronger and better together than we are not. And by virtue of having the conversation, we learn things together. So again, kudos to you. And thank you for sharing that very interesting detail, because you see me jotting down notes when you're saying some things. That's what I was jotting down.
Yeah, so I actually looked into this when I was doing a down payment assistance program for teachers here in Nevada. And she really wanted the down payment assistance that came with it and the below market interest rate. But the mortgage insurance was almost like a deal breaker. So when we looked into it and we realized, oh, you put 10% down, it's a win-win, because eventually that mortgage insurance goes bye-bye. And you get this below market interest rate, and you get the $7,500 that you never have to pay back in the form of a grant from down payment assistance. So there's a lot of cool things that, you know, us loan officers can do if we have the information from you and we know what your long-term goals are. You know, we can research and make sure you're getting the very, very best.
Thank you for that, Celeste. And that's what's so important to have a channel like this, and some of my YouTube counterparts that are starting up, and some of the people that have been around for a little bit, is to have these conversations, bring professionals on with us just like you. Because when someone says, oh, my credit score is like 740, Andrew, I'm pretty sure I can get qualified for them. Well, the answer is always just no, maybe so. It depends on your debt to income ratio. It depends if you have a bankruptcy. It depends if you have collection. And that's where, you know, we start going down these rabbit holes. And I was recently reminded, Andrew, try to keep it more simple than what you presently do. You dive down sometimes and you kind of start darting in the rabbit holes. I'm like, well, it's the truth. And they're like, well, you need to try to keep it more simple. So in the simplistic form, the answer is always the same. The best way to know what kind of loan programs you can qualify for is to simply do a mortgage application and then begin that conversation with your loan officer. Because the truth is this: you can hear this, your friends can say that, your family can say this, but the truth is that every loan is unique to the person that's applying to the loan based upon their economic and financial profile, right? So that's where, when we start talking this stuff and you're hearing this wonderful insight coming from an actual great loan officer like Celeste Harvey at Fairway Mortgage, it's important for you to know that what we're sharing with you is like on a bird's eye view. And if we want to drill down to your situation, you need to do an application either with Celeste if you're here in Vegas or in one of her service coverage areas, or with a loan officer if you're choosing elsewhere. But most importantly, by knowing the questions to ask and knowing the reality is that everything is going to be different based upon your economic and financial profile, then you can start getting the best of answers of what loan programs are available, the trade-offs between loan programs, because some of them are more favorable than others. All of them are favorable, in my humble opinion, if you're in between renting and buying. At the same time, you need to always have full vision of what you're getting yourself into. So I remember in the Marine Corps, Celeste, they always said, you need to follow the KISS method, right? It means you got to go around kissing everything, right? Not quite. So KISS was an acronym for keep it simple, stupid. And they always said, who's stupid in the picture? The one that can't keep it simple. Stupid.
I've never heard that, but I love it. That's so
well,
funny.
The Marine Corps is chock full of craziness. I mean, we got our own way of teaching things and coming up with acronyms for acronyms, and then we come up for a new acronym. So different rabbit hole. Let's keep it simple.
Yeah.
Stupid, right? So
keep it simple. Mortgage loans are not a one-size-fits-all. Mortgage interest rates are not a one-size-fits-all. So just keep that in mind.
Very good. Thank you. Speaking of that, so let's move on. G. Alfred, thank you so much for joining us. G. Alfred says, hey, Andrew, I'm in the process of buying a townhouse for $239,900 in Illinois. My loan officer did suggest buying down the rate to 2.75% for $1,830. Is it a good deal? I'm not sure if I will be there more than 5 years due to the HOA. My FHA loan is with a 5% down payment. Thank you for all of the details, G. Alfred. That really, really helps in providing you with some assistance here and some insight. Celeste, what are your thoughts on that situation based upon all the information that we've been providing and the value that you've been giving with that educational chart, and now knowing he has a 5% down payment and the rate buy down is going to be $1,830. And he's probably not going to be there for 5 years.
It really just depends. I would have your loan officer do the break-even analysis for you to figure out when is your break-even point. For me, it's really hard to do because it's something, I'd have to price out based on your, credit score, your loan to value, which is 95%. Is it I'm assuming it's a primary home. Are you doing a 30-year fix versus a 15-year fix? So kind of have your mortgage loan officer do something like I did here in this example, but for you, showing the different options that you have, and then calculating how much monthly savings you get and in return when you break even. And, but if you're only planning on staying in the home for 5 years, it may not make sense. You may not be there long enough to see the savings you desire. So do the math.
Yeah, do the math. It all comes down to do the math. And in your case, Mr. Alfred, guess what? It's your loan officer's job to do the math. So just ask them to do it and give you that break-even analysis, my friend. Hope that helps. And thank you so much for the wonderful question. Olga says, I'm planning to buy my first home. Olga, we're super excited for you, and I hope that you find these live streams and the other videos on my channel very informative. Those of you that have been following me for a little while or even new to the channel, thank you, of course. I always appreciate your ongoing support and for sharing this content around with your family and friends as well. That said, I am slowly working on the homepage to try to go through all of these 670 plus videos and put them more into different types of buckets, if you will, or playlists that are a little bit easier to find exactly what you're looking for because there's so much content. And I was like, well, I need to try to refine this out. If someone has questions about credit scores, I've done several videos about that. So I made a playlist for that. Refinancing, same thing. So home loans and stuff, same thing. Celeste and I are preparing, aren't we, Celeste, to come up with a new series for conventional loans. Just she and I talking about everything to do with conventional loans to break it down and make it simplistic. So Celeste and I are working on that. So you'll see that comment hopefully on the channel within the next 30 or so days or less. But it's one of those things that just know that it's coming. And of course, any suggestions you have, I watch them all. I read all your comments, and I really appreciate and love all of you that are here on the live stream, after the live stream, and just in general, just love you all for being part of our tribe. Like my good friend Sean Cannell says, love it. Got to always say it too. Your vibe attracts your tribe. So let's make it a good vibe to have a great tribe. So Nathan says, when considering time to live in the home, you must also think what you could invest the money in at invest the money at as well, or you mentioned in the video, if you wanted to have a refinance. Okay, let me reread that. That didn't come out right. When considering time to live there, you must also think what you could invest the money at as well, or as you mentioned in the video, if you may have wanted to refinance. So I think, and please correct me if I'm mistaken here, Nathan, whenever I'm reading that, trying to put it in context here, it sounds like to me that when you're looking at, hey, do you want to pop off the $3,000 to $6,000 in the case of the example that Celeste was making here on this $300,000 loan amount? Again, all the wonderful disclosures there for legal ease. Yeah, you do have a point. Are you going to earn more money with your $3,000 or $6,000 in the financial market, in your Roth IRA, in your 401k, whatever the situation may be? Because that almost sounds like an opportunity cost of money and investment principle where you can get the best bang for your buck, and whether you can have more money being earned off of that money in that investment. And I think that's a relevant question, Nathan, because I do work with different people that those kind of considerations are very real. Even if they can get a lower amortized amount and interest that they're paying out over time, they're more concerned about, if I have $6,000 today, where can I get more than a potential return in the future? Is it going to be in the market? Is it going to be investing into real estate? Is it going to be what have you, right? So that's what that kind of sounds like to me. And the same thing with the refinance. And it's one of those things, I'm not sure if you come across that a lot, Celeste, but on my real estate side of things, whenever I'm having these conversations, getting them over to you or, loan officer to have the conversation, sometimes that's one of the things. Well, I could do a 20% down payment, but I'm not sure that the savings are high enough for me not to want to invest the other money into the market, which to me is always a gamble. But historically, if you play your cards right, you can earn some dollars, and a lot of people have become very wealthy doing it. So it is worth the consideration whether it should be going to a 401k. Have you come across families that are kind of curious about the same thing, if they should really go there, even if they could, or if they should invest it elsewhere?
Yeah, I get that question all the time. And you can look at it from two sides. You can look at, okay, just say the $6,000 I would spend to buy down the rate, hypothetically, you could invest that into other places, or the $23,000 you would save over the 30 years. You can also look at investing that money as well. So it all comes back down to, what is your long-term goals? You need to get with your real estate agent, your loan officer, and your financial advisor. Your financial advisor can take a look and build out a long-term strategy for you, and figure out how you want to diversify your portfolio. So what you discuss with your financial advisor might impact what you do with your mortgage loan. And it's not uncommon for financial advisors to reach out to me and ask me questions and make sure that, everything's in line, everything's in tune with the client's long-term financial goals. So sometimes, working with a loan officer, a real estate agent, and a financial advisor who are cohesive and, working in the benefit of you, the client, can really make a difference in your financial portfolio.
Mm-hmm. Thank you for that. I was actually jotting down a note about the opportunity cost of money versus, in the sense of rate buy down versus the total amount of down payment versus investments. So I think that's definitely a really interesting topic that we should probably touch on in the future here. Nathan, thank you. Nathan, thank you so much for bringing that up. Olga says, I'm planning to buy my first home in spring of next year. When should I start talking to a loan officer and a real estate agent? Olga, I've made a lot of different videos, and my honest to God thought process on when you should begin the conversation with a trusted real estate advisor and loan officer is anywhere between 3 months to 12 months before you're ready to go. And why do I say up to a year away? And it's very simple. A lot of people that apply for a mortgage aren't always as ready to go as they thought they were. And sometimes things take work. Sometimes credit scores have to be worked on to get their credit score up. There's a lot of different things that come up. Sometimes people are surprised they have something in collections. They didn't even know somehow that they had something in collections. These things come up. And the best way to know and how to prevent that, if your goal is to be buying next spring, right, is to do a mortgage application. And by virtue of doing the mortgage application, the loan officer can start pulling everything up. If there's work that needs to be done, you have nothing but time for the next 12 months to get your financial house in order to be able to purchase. By getting in touch with the real estate side of this, then you're able to start pinpointing and learning more about the area and watching the different type of homes relative to the price range that you're looking or at least considering in purchasing, right? The other benefit of having both the loan officer and the real estate agent at the same time is once that loan officer says, hey, I think that if you take XYZ steps, you would get approved for, let's say, $400,000. Okay. Then you tell the loan officer, and hopefully the loan officer and real estate agent know each other and or are working together very well, cohesively, as Celeste mentioned. Then the real estate agent can set you up on a personalized home search report matching your criteria, and you can begin watching what's happening in the market. Now, if everything works out swimmingly, right, then you might not decide to wait until spring. You could decide to wait to next spring, or you could decide to take advantage of the historic low interest rates, which I don't believe will be here forever. But either way, the choice is yours. And with the power of the choice being yours, you have the option to pursue what is right for you in your life at the time that makes sense to you. And if that's next spring, rock on. So all I'm asking you to do, and anyone else watching, is to initiate your application. Don't be afraid of it. Celeste broke down the application last Friday, showing you how simple it is to do one, and it's painless. Might as well do it so that if there's work that needs to be done, long story short, get it done. But if there's not, then now you got your stamp of approval and validation, and now you know exactly what your budget is to go home shopping. What do you think, Celeste?
I think you explained it really well, Andrew. I mean, say there's stuff that needs to be worked on, your loan officer can guide you to make sure that you qualify in the springtime so you can get out and go shopping. If you have all your ducks in a row and everything looks good, then your loan officer will ask you to maintain everything that you're doing, maintain your credit, maintain your savings, maintain your employment and your income. And at least okay, when you're ready to start looking at homes, then the loan officer will refresh your application, ask for new documents, and refresh your credit report right before you go out shopping for a home in the springtime.
Perfect. So, Eric, I see that Eric Presser is up. So, Mr. Eric, how are you, sir?
I'm doing okay.
It is great to hear your voice, my friend. It's been a while.
How are you doing?
I'm doing very good. So, Eric is actually one of my past clients, really wonderful gentleman from New York. So, Mr. Eric, how can we help out today?
Oh, I'm just listening in today.
And did you have
very interesting? I've been listening now for a few weeks on the live ones, and it's pretty good. I mean, I'm listening through YouTube, but it's very interesting.
Awesome. Well, do you have any thoughts or anything that you'd like to share with the world today?
Not in particular. I mean, I'm really glad and happy that I bought with you and with Bill, and everything's great.
Okay, fantastic. Well, Eric, it is such a pleasure to chat with you, my friend. Please keep listening. And if you have any ideas, of course, you know that we're always here for you and always standing by. And by the way, I still have that nice little disc I promised you in the envelope in my safe at my office that's just waiting for when you come to town, and we'll be able to get together and go grab a bite to eat and have some good times and give you your envelope.
Sounds great. Okay.
Thank you, Eric. Really appreciate you, my friend, and hope that you and your family enjoy a gorgeous weekend. Stay safe, by the way.
You too. Thank you.
Bye-bye. Okay, that's awesome. So Eric is somebody that I had the great pleasure of working with earlier this year, and had started watching the YouTube channels, and now is watching the live stream. So such an awesome opportunity to have him join us. Love it when we have people that want to join us live, and always full of positive energy, and him and his family are that. So really wonderful people there. Remember, good people attract good people. Well, the Presser family are some of those really good people. So let's move on to Miss Claudia. Miss Claudia says, thank you. I learned something new every day. Thank you, Claudia. I'm glad that this is helping you. Amy, thank you so much for bringing up this topic. I was jotting down a note a moment ago when Celeste was talking about a gift of equity. So this past Monday, Bill, we got that question again from, I believe it was one of our tribe members named JV, or goes by the screen name JV. And Bill started drilling down pretty hardcore on gift of equity. It's not something that a lot of loan officers see too commonly, but Bill, given the volume of loans he's done over the last almost 15 years, has come across it. So what I'd ask you to do, Amy, is go back into Monday's live stream, please, and watch that video, and just kind of maybe if you just want to scan it kind of quickly, go 2x speed or 2.5 times speed using the gear icon until you hear us start talking. You see the pop up of the gift of equity portion, and go into that, because Bill was starting to get pretty involved with how that works and what you should know, and some different questions to be asking and some different considerations for you. And the reason I was jotting that down is because now in the last 3 weeks, that has come up 3 times.
Yeah, that's so weird.
I don't find that to be a coincidence. Once, okay, never heard of it before, but it's a thing, right? I, as an agent, never heard of it before. Then Bill, it comes up with Bill, and then he goes into it, and now it comes up today. That tells me that we need to make a recorded video content really outlining and breaking this down. So, Amy, thank you for that, and thank you for everybody else that has that question as well. It's a very, very good consideration. It's something that we will be making. So G. Alfred says, thank you so much, you both. I learned a great deal today. Glad to help, Mr. Alfred, and super glad that you joined in today. Let me see. Natalie Reyes says, I qualified for a USDA guaranteed loan at 2.74% interest rate. Wow, that's such a low rate. God, these rates.
Yep. Whew, see how I say it depends on your loan program. It depends on your credit score. It is very possible to lock in at a rate that low. And it all just depends on what your situation is.
Absolutely. Thank you, Natalie, and for letting us know. I'm super, super excited for you. Let us know how everything plays out into the future with your home search. It'd be great to hear from you. Shango says, is it better to get a 15-year loan or a 30-year loan? Now, Celeste really went hardcore on this not too long ago. In fact, wasn't that like last Friday's live stream topic was a 15 versus 30?
I think it was, no. It was the Friday before, so it was 2 weeks ago.
We do so much. We do so many of these topics, Miss Celeste. So
last week was we have Michael.
That's right. Is now a good time to buy a house? So the previous Friday. So Shango, Celeste and I really went deep, and she had, of course, some very educational charts to help out with the 15 versus 30-year loan. I'd ask you to go back into the Real Estate Live playlist on my channel, check out that video. I think she spent the first 20 or so minutes of that video really diving deep into whether it was a good idea to go 15 versus 30. But ultimately, at the end of the day, it really begins with the same question. And it's always beginning with the end in mind here. How long are you going to live in the house? Because it really dictates what's going on in your situation. And just to give you a little sneak peek, so to speak, when you're thinking about 15-year versus 30-year, it's also going to come to a monthly cash flow position versus long-term savings. Just something to think about, something to consider. Please check out that live stream with Celeste. Right there in the thumbnail was 15-year versus 30-year mortgage, and that's what that whole topic was about. And if you still have questions, then please feel free to reach out. And as always, Miss Celeste is available if you would like to chat with her. Her contact information is here and also in the description below. So thank you so much, Shingo, for joining us, and thank you for the great question. And look forward to hearing from you again soon. So one thing that I did want to do, and we were so fortunate today, and thank you all of you that are here with us for making it such an awesome stream today with the engagement. And of course, if you have any additional questions about rate buy downs or anything else that's on your mind, please feel free to drop us a line in the comments or simply hit us up in the chat since we're live right now. But after the fact, please definitely don't be shy of leaving us a comment. Speaking of comments, I wanted to show some of the comments that I see on my side. These are some of the comments that came in over the last 24, 48 hours or so. But I thought this was pretty funny. You guys make me laugh with some of these comments, and it's really positive mojo a lot of times. So it says, hi, Andrew. I have the ammunition to ask loan officers now. This does include Bill Marin, by the way. Lots of laughs. Thanks for the tutorial. Referring to the 9 questions to ask your mortgage lender. And then you get some really interesting questions and situations that come up in these comments. There's literally thousands and thousands and thousands of comments on the channel. So when I'm thinking about content to create or how to approach things and how to challenge myself to improve my abilities and skills as a real estate agent, this is what I'm looking at. So you get Rachel then that was watching my video, Negotiate Your Home Price Like a Boss, and says, well, what do you do if your realtor is lazy and trying to bring your house down too soon? Well, the context of that would kind of mean, well, she's probably referring to a listing agent in this case. And she's probably saying that the listing agent is saying, hey, you need to drop your price, you need to drop your price, you need to drop your price. Well, I have different considerations and points of view on this because it would really depend, number one, where did you start your price? And did you start your price at the fair market value or slightly under the fair market value to begin with? Because if you started your price high, then a savvy buyer agent, whenever I represent buyers, let's say Celeste was my buyer, one of the things that I always do, and I've made a video on this too, is to do a comparative market analysis prior to submitting an offer. You need to know what the valuation of that property is. And you need to make sure that home can appraise for the value that you offer, because ultimately a buyer cannot get more home loan than the appraised value. So whenever I see this sometime, I'm not so sure if maybe the realtor's lazy. I mean, I don't want to cast any dispersion and put negative energy out there. But what I can say, when it comes down to pricing out your home and doing price reduction, it really depends on where you started at. If you started at fair market value and you had the appropriate marketing action plan going into the strategy to begin with, and you position your home correctly, you shouldn't have had any issues getting it sold even in the COVID timeframe where we were all at stay-at-home orders. Because the reality is, I was selling homes anywhere between $268,000 and $600,000 as a listing agent, and they were selling in less than 5 days, even though everybody was stay-at-home order, right? So it has to do with positioning and how to present a property, and keeping in mind that you're playing Match.com with your home. Now, what responsibilities do you have as a seller? Well, if your house is tore up from the floor up and it smells like yesterday's garbage, frankly, that's not cool, and you're going to have a hard time selling. So it's all about understanding that Match.com is about a buyer, just as we've talked about today with the rate buy downs with Celeste, that it feels so compelled, so desirous of your property. They wish to marry a 15 and 30-year mortgage, because that's then the reality of a lot of buyers, or part with that much cash if they're cash buyers. So I wanted to say, Rachel, hopefully you catch the live stream. And I'm going to go back through these comments later on and let you guys know, of course, that I was towards the end of the video referencing you guys and mentioning your comments. So if you want to watch, then hopefully you'll get the answer to your question. If you had additional questions in your case, just let me know. Rafaela says, watched pros and cons of first-time home buying and said, hey, Andrew, first-time home buyer here and love your channel. Even your older videos are still very relevant. I have a question for you. We are still renting, and I agree we should be using this money to build equity. However, which would be better, to use the amount we currently have for a down payment on a starter home, or should we continue to pay rent until we can save more money to buy our forever home? Thanks for all your help. And that was one of the comments I really wanted to drill on, because this was really amazing right here. Now, Celeste, when we talk to people, this is a common question that comes up. And Rafaela, thank you so much for taking the time. Number one, let me know you've been watching the channel for so long and that you're still enjoying some of the older videos that I have out there, especially as I continue to improve my video quality and stuff. So thank you for that. But when we're talking about the rent versus buy scenario, this is an interesting one, because the sooner that you can get into home ownership is the sooner that you can start building up your own equity in yourself and in your property. And if you're in that position when you start trying to weigh out a down payment, hey, we can get a down payment on a starter home. We got that ready to go. Or should we continue saving up for the forever home? Here's the reality. If your rent costs like $2,000 a month, right? That's $24,000 a year that you'll never see again. You're just flushing it down the toilet. You're never going to see it again, right? But if you got started into a price point that's affordable to you, like this lady saying, Rafaela saying, a starter home, then the reality is over the next 12 months, you will have paid down your principal and interest by a factor of 24,000. The reality is the real estate market will be the real estate market. It will appreciate, it will depreciate, it will go up, down, and all around. But historically, we know that real estate rises. And since we're all people, and last time I checked, and please correct me if I'm wrong here, everyone, all of us as people need a roof over our head. We need food in our tummy. We need fresh water to drink. And we need clean air to breathe. So the point of that is we need shelter. So we could choose to own that roof, or we could choose to rent that roof. The choice is yours ultimately. But if by getting your foot into the front door of your very first home, you're able to let that home start appreciating, and let's just even say it's only 3% appreciation, right? Which is the 100-year historic average for real estate, by the way. And over the next 12 months, she pays down $24,000 of the principal interest on a $300,000 home, let's say. And then she gained 3% in equity. That's $9,000 that she did nothing more than pay her mortgage. She didn't have to work anything special for it. Didn't have to work any harder for it. And let's say they were going to live there or planning for 5 to 7 years. Start doing that math and watch how it starts compounding and watch how much equity is starting to go in there. So in addition to what she and her husband or her family that she's buying this home with are able to save up for the next down payment for the next home, they're going to now have the equity that they've been paying down over time on that property, plus the equity that the real estate market has appreciated ideally over time into that property. So then when they go to sell, not only will they have the amount of down payment they want for their next home, but they'll be able to make a larger down payment if they wish to, or they may even be able to qualify for more home. They'll have options is the point. And it's all about having the choice, and it's all about having that power to do that. But to have the power to do that, you must first have the option. And that's where I share with you that if it makes sense to you, for the reasons that are important to you in your life, to buy or sell a home, to always do it when it's right for you at the right time in your life. Don't chase the market. Simply decide how long you're going to live in a place. What's most important to you about the situation? What do you want, and how does it fit into your life goals? And make a well-informed decision moving forward into your life. So I did that. It was the one that I read this morning. See, it came in 12 hours ago, and I was reading it this morning as I was having my coffee. And I thought, I really would like to give that shout out to Rafaela there, because I thought it was such a wonderful question. So thank you for that whenever, and I hope that helps other people during the live stream and obviously after the fact too. Okay, so here we go. Shango says, I see a comment, and then we'll start winding this down. Shango says, if my house was appraised for $300,000, is that the fair market value? Is that what I should start with if I want to sell my home? It's a great question, Shango. So essentially, when we're looking at that, what we want to do is, if your house was appraised for $300,000, if it was a real estate appraiser that appraised it, then yes, that's an appropriate start price. If it was a real estate agent that assessed the value through a process known as a comparative market analysis, and if that is a realistic fair market value, then yes. As a listing agent, when I list property, it is always best to list a property at fair market, if not 1 to 3% under market value. And you might be saying, of course you say that because you're a real estate agent and you want a quick sell. Nope, not at all. But if you want your home to sell, it's the truth. Because if we're going to drive a multiple bid on your property, which means that we can get a higher price on your property, it doesn't start by starting high. It starts by starting right. And starting right is always a fair market value. Now, if the market loves your home, it will always tell you whatever it thinks, or whether it loves it or hates it. It's always going to tell you pretty quick. And a way that it tells you that is about how many showings you're getting and how many offers you're receiving on your home. Now, it is a very statistical point of view that I have made and dove very deep into over the years on some of the videos I've made about listing stratagems and such. And if you wish to go back and watch them, please do, because I do nerd the heck out on some of those. But where I'm going with this is, if you start high, in many, many cases, what you'll find is that you're dropping your price. It takes longer to sell. Your carrying costs are higher, and it's also preventing you from moving forward. At the same time, mortgage interest rates are going up, down, and all around. Home prices are going up, down, and all around. You're throwing off and derailing your own life plans the longer it takes to sell the home, and the longer the home sits on the market, what generally happens. And this is where it gets fun, because buyers will think something is wrong with your home if they think it's been on the market too long. When I share with buyers here locally in Las Vegas, our current average days on market right now, about 90, 92 days on market on average across the board, right? They're like, oh my God, that's so long. It's average across all price ranges, everything else, it's average. Is that to say that homes don't sell in a day? Not at all. Does that say they don't sell faster? Not at all. But what is the difference between those homes that sell quickly and those that do not? You'll find it goes to a marketing plan of action for the listing agent and you working together. You'll find that it goes into pricing strategy. You'll find a lot of different variables that go into it. But the point that I'm making, and a buyer's like, Andrew, I noticed this home was on the market for 30 days. What's wrong with it? It's been on the market forever. Like, no, average is 92. Just saying, right? So the reason that this is important to know, the longer you're on the market, you're going to have to keep dropping your price. And what will happen is you will more than likely end up selling for less than the $300,000 you could have received had you started at the $300,000. And it may take you 6 months, 3 months, or longer, whatever the case may be, to get it sold. So these are the very real considerations and why it's so important to check out videos like the one that I made with the 20 questions to ask a listing agent. Ask those questions, gain clarity and insight on why you're selling, and make sure that you have a robust plan of action and have a timeline in mind of when you'd like to see it come to maturation. So that's a really good question, Shingo, and I could go a lot deeper on that, but I'm just going to work again. I'm not going too deep down these rabbit holes, darn it. Kiss method, right? Keep it simple. So, Corey, we close on 7-1. Oh, wow. Congratulations. And everything is done, but the buyers of my property have not provided a loan commitment letter from their bank yet. Should I be worried? Celeste?
So, I mean, I keep everyone informed. When I'm representing a buyer and they're purchasing a home, I'm in contact with the listing agent and with the buyer's agent, and I let them know when we reach certain milestones, like, hey, the loan is in underwriting. Hey, the loan came out of underwriting. We're conditionally approved. So I would definitely reach out to your listing agent to contact the mortgage loan officer to find out where they're at in the loan process. Because if they're not cleared to close by now, I mean, 7/1 is coming up next week. I believe that's Wednesday. So I would find out, is a buyer clear to close? Are they starting to work on generating final loan documents? Those are probably questions that the listing agent should be asking the loan officer.
And also getting with the buyer's agent as well. So keeping everybody in the same sheet of music, because you're absolutely right. Because if that CD hasn't gone out, that closing disclosure that hasn't gone out yet, and you need 3 days and not including Sunday, then you're coming up on tight turn times. So it could also be an inclination like what Celeste is saying, find out that most important detail, the clear to close authorization, because that precedes the closing disclosure, right? So with that being said, if it doesn't happen in the next today or Monday, then they're going to push you for an extension, because next weekend is the 4th of July. So when you start looking at that, some people may be cutting out of the shop, so to speak, come the 3rd. Celeste and I will be here live, though. So she and I talked about that. She'll be in San Diego, but she and I will be live together. That said, it is very important, Corey, to please get with your listing agent, have that conversation with your listing agent, ask your listing agent to get with the buyer's loan officer and the buyer's agent, get everybody on the same sheet of music. And another little pro tip here, right? So anyone that's watching this after 66 minutes, essentially, guess what? Now you're getting one of my favorite little tools of the trade. Call the title company. The title company is considered a neutral third party to a transaction. Very simple to call. Hey, are we on track to close? You'll know pretty quick the answer to that question, because the loan officer and the title company have to balance, and they have to get their numbers right before they can prepare for the buyer signing appointment to sign.
Yep. And the title company should have some idea when they're getting the final CD and final loan documents from the lender. So if they haven't received that quite yet, or they don't know when they're going to receive it, that could indicate maybe the buyer is not on track to close on time.
Fantastic. And everyone, Corey, I hope that helps. Please let us know how it plays out. Now, just to give everyone a heads up, we won't be live on Monday. I do have a training course coming up that's going to be pretty intense, Monday through Wednesday, 10 hours a day. So it's something that I invested a good amount of money for education in, and I'm going to commit, bite down, and take my 30 hours of straight up intensive, immersive education. So we won't be streaming Monday, long story short, but we will be streaming next Friday with Miss Celeste. And I believe Celeste was potentially wanting to talk about mortgage insurance and see if we have one of her associates that would come on with us.
We're also getting all the jobs report data next week. So we might talk about jobs again. So we'll see. Either jobs.
We'll talk about it all. We'll talk about all of it, right? And we'll have a good time before everybody turns to on the weekend. And remember, wear your mask, regardless of political affiliation. It's not about each of us individually. It's about us together as people and being stronger and better together, because that's what it's all about here. And on that note, let us go ahead and wind down. And speaking of that, going into the Friday, I hope that everybody enjoys a wonderful Friday, a beautiful weekend, and please go out there and be the reason someone smiles today. We'll see you next Friday and enjoy a great week.